All right, so we're on chapter 11, and we're talking about property, plant, and equipment, intangible assets, utilization, and disposition. All right, so there's a lot to cover in this chapter, so we're going to get started here. And when we buy things that are going to last a long time, like property, plant, equipment, we're thinking about our buildings, our equipment, manufacturing items, anything like that, things that are going to last us a little longer than a year. Okay. We are going to depreciate them. Okay. Then when we have natural resources, we will deplete them. And then for intangible assets, we will amortize them. Okay. So if you see depreciation on the income statement, you know it's property, plant, and equipment. If you see depletion, you know it's a natural resource. And if you see amortization, you know it's an intangible. Okay. When we are talking about cost allocation in this chapter, we are just talking about allocating the cost of those big ticket items, the big building, manufacturing equipment, vehicles, delivery trucks, all of those things. We are looking at just allocating the cost. We are not necessarily trying to follow the fair market value of the asset. Okay. That kind of happens a little bit more on the IFRS side, not on the GAAP side, though. Okay. So let's jump into this first example here. We have a company purchases a truck for 82,000 to deliver products to customers. The company estimates that 5 years from the acquisition date, the truck will be sold for 22,000. That is our salvage value right there. Okay. Now, when I'm doing problems like this, I really like to get a little blurb of information over here. I don't know that we're going to need it, but this just really helps you get everything in one spot so you don't have to go back and read the paragraph a couple of times like I would have to do. Okay. Salvage value is 22,000 and estimated life is 5 years. Okay. So $60,000 is what they call the depreciable base now. They come up with a fancy term. It is just the cost minus the salvage value. Okay. On the truck's purchase cost will be used up during the 5 year life. Okay. 60,000 is going to be used up over 5 years. And how we allocate that is a couple of different methods. Okay. So they're not going to do that with these, but I highly suggest you get you a little bit of blurb of information in the margins. That way you don't have to keep going back and reading over it. If you don't have ADHD, then you don't have to worry about that. Okay. There are some things that we don't know that we estimate when we are measuring this cost allocation. Those three little things up there, the only thing that we know for certain is how much we paid for it. Do we really know for sure that it's going to have a value of 22,000 at the end of 5 years? We really don't. That's an estimate. Do we really know if it's going to last us 5 years, less or more? At this point in time, that's our estimate. That's the best estimate we have at this moment. Okay. So service life, we are going to estimate that. Okay. That allocation base is just that depreciable cost, the acquisition cost minus the residual value. Okay. And how are we going to allocate it? We have a couple of different methods that we're going to use. Okay. So service life, the amount of use the company expects to obtain from the asset. It can be expressed in units of time or activity. So you may see years, okay? Or another common one is or miles, okay? Especially if it's a delivery truck, and I believe that example was a delivery truck, so we can measure that in miles. Some items it's really hard to measure some sort of unit, okay? I always think of our accounting classroom or any classroom that you are sitting in. And learning, it does not matter how many people are in those seats, that building is depreciating at the same rate. Okay. So we really don't have an activity that would match up to a building depreciating. Okay. It's going to look more very straight line-ish. Okay. We're not going to be able to measure it in units because it does not matter if there is one person sitting in that classroom or if there is 50 sitting in that classroom. The building is depreciating at the exact same rate. Okay. So, kind of talked enough about service life. When the service life is less than the physical life of the asset, we're going to use however long we're really going to get value out of it. Okay. When this happens, we're usually expecting a lot of technological change. It could be sold in a market that frequently demands new products. I always think of iPhones and how fast phones change. I feel like they've kind of tapered off a little bit in the last few years. They don't seem to be changing quite as fast, but that just might be me. Okay. Consuming a natural resource is only economically feasible up to a certain point. Okay. So there might be um, 10,000 tons of ore, but they may not only be able to get to 9,000. Okay. We're going to use 9,000. We're not going to use the 10,000 because we're not going to be able to get the other 1,000. I went to last summer, went to Phoenix, Arizona, and we went to an old mine that was out there in the middle of the desert. One thing I thought was really interesting is when they hit water, they're done. It does not matter how much gold is underneath that. They cannot do anything else because the mine would constantly be flooded. So I thought that was interesting. So you hit a certain point, so you got to make sure that you're still getting what you can out of the mine, but don't go too far. You don't want to hit the water because once you hit the water, you're done. Okay. There's just no way, it's not economically possible to get all the water out and actually mine what's left in there. Okay. There could be a legal or contractual amount on an intangible asset. We may only have 5 years to use a patent or 10 years on a franchise, something like that. Okay. Management's policy may shorten the period of an asset's usefulness as well. Okay. Management might be more inclined to, depending on what there might be, a motivation as to make net income go up or down. They might pick policies that will help them if they got bonuses being based on something. They might have a little bit of bias to use one estimate versus another one. Okay. So that does tend to happen. Okay. We've kind of talked about allocation base already. They sometimes call that the depreciable cost. It is just the cost minus residual value. Okay. All right. So, which method we're going to use? There is a lot of things to consider. Um, it should kind of correspond with the benefits that we're going to get from an asset. So, we want to make sure we're kind of using, that time base that we are confident that we will use this asset. Okay. Time based or activity based. Okay. Pretty much everything when it comes to natural resources is going to be an activity based, sort of like units of production, but the units might be acres of trees, barrels of oil, tons of ore, things like that is how they would measure the base. Okay. All right. If y'all wanted to take a second and pause the video and do that one, you are welcome to do that. Okay, so here are some methods. We have done several of these already in previous classes. Some of them are going to be new to us, so we're going to learn a couple of new methods. One in particular is sum of the year's digits. It was tested when I took the CPA exam quite a few years ago now. Um, I don't know why it's still tested. I don't know of any business that is actually using sum of the year's digit. It is an accelerated method. You remember we did double declining balance, but it is an accelerated method. Um, Many years ago, before I started studying for the CPA exam, I was tutoring online, And a student asked me about some of the year's digits, and I was like, I don't even remember how to do some of the year's digits. I had to go Google it myself and remind myself how to do some of the year's digits. And so I figured it out really quick and was able to help the student, but I was just like kind of deer in the headlights, like I haven't heard that term in a long time. Okay. Units of production is going to base the depreciation on the rate of usage. Okay. So they give us a problem here, and I believe we're going to use the same one for a couple of different um, methods on depreciation. Okay. So they tell us at the beginning of year one, Hoover Manufacturing Company purchased a machine for 250,000. That is my cost, 250K. The estimated residual value or salvage value, they mean the exact same thing, so don't get hung up on vocabulary. And I don't know why my screen is giving me grief. There we go. 40K. Estimated life is 5 years or 140,000 units. So this is something we can measure in units, which is great because then we can actually do that units of production method. Okay. So estimated life is 5 years or 140K units. Okay. They give us some of these units. Okay. Notice they didn't equal 140. We'll get to that here in a minute. Okay. The first one we're going to do is the easiest and probably the most common of all depreciation methods. Okay. It is straight line. We just take the cost minus that estimated residual value and we get the depreciation per year. It is the same. We can make the exact same journal entry for all 5 years. That is why it is most commonly used because it is very easily calculated. And you would think that some people who are doing these things are accountants and they should be able to do these hard ones like double declining balance or some of the year's digits. But in the end, straight line is easier for everybody to understand. Your accountants probably wouldn't mind using those methods, but other people in the organization may not understand them. Okay. So they calculated that at the 42,000 every single year, the depreciation expense will be 42,000. So you can see how that stays the same. Accumulated depreciation. Okay. I'm going to draw some T accounts out for us here in just a minute so you can understand again what accumulated depreciation is. Okay. The journal entry is going to be depreciation expense, credit accumulated depreciation. Okay. So let's talk really quick about this is okay. Equipment, and I can't remember what its cost was. Cost was 250,000. Okay. So we put 250K in the equipment. After the first year, we have this accumulated depreciation for the equipment. Remember, equipment is an asset. It has a normal debit balance. And then we have our accumulated depreciation, which is our contra asset. It has a normal credit balance. Okay. We're going to record that 42,000 in there. And after this transaction, the book value of this will be 208,000. I think they gave us that. Yep, there it is right there. Okay. So that's where they got the 208. Okay. They will make that exact same journal entry every single time. That's why they said, well, they just said divided by 5. So if they did this one, this journal entry, 5 times 5, then they would ultimately end up with, is it 210? So if we multiply that times 5, we would end up with 210,000 in that account. And then we'd have 250 over here, and our book value would be 40,000. Remember, that's our salvage value. Okay. We can't depreciate that because we plan on getting that back. Okay. We plan on getting that back. So we're not going to depreciate it. We could keep on using this piece of equipment for 10 years. It can sit on the books just like this for over 10 years. Okay. We've depreciated it down. We're not getting any depreciation expense, but we're going to keep on using it. Okay. So here they give you a little quick concept check to do the straight line, but I want to get on down here to double declining balance. Okay. Double declining balance. So we're using the exact same things here. Okay. Cost is 250K. Salvage value or residual value is still 40K. And estimated life is still 5 years. Okay. We're going to use the 5 years, so I'm not going to write the 150,000 140,000 units. Okay. So double declining balance. The first thing we're going to do is find the straight line rate. What is the straight line rate? That looks like a 5. I need it to be an S. The straight line rate is always 1 divided by the number of years. Okay. So for this one, it is 1 divided by 5, which is 20%. If we put it in percentages, we need it in the percentage, the 1/5. I guess we could use the 1/5, but it's just easier when you do it in percentage. So we said double declining balance. There is a such thing as triple declining balance. If it was, then we multiply it times 3. But most of the time, you'll see double declining balance. Okay. I've even seen 150% declining balance, and that would just mean multiplying that times 1.5. Okay. But it's as double. That's the most common thing, which gives us 40%. Okay. So we are going to start the very first year. We're going to take the 250,000. Notice this is the one method we do not subtract the salvage value out first. Okay. We wait to the end because we could continue to get a percentage of a number over and over and over, but that's why we don't subtract it on the front end. Okay. So we're going to multiply that whole amount by 250,000 multiplied times 40% gives us $100,000 of depreciation year one. Okay, that's a lot of depreciation in year one, but I want you to think about it. There is a lot of vehicles that you can drive off a parking lot and they depreciate a lot really, really fast. Okay, some people would argue double declining balance may actually follow fair market value a little bit more, but it seems crazy where we just went from depreciating it out, it's nice little 42,000 or however much that was a year, to craziness of having $100,000 of depreciation expense in year one. Okay. At the end of year one, our book value is only 150,000 of this. Okay. So now we're going to bring down the 150,000. That's the new beginning balance. So that's why they say it's a double declining balance. Okay. Notice that number does not take out the salvage value. We're going to multiply it times 40%. We're going to get 60,000 of depreciation expense in year two. Okay. My book value has now dropped to 90,000. We're going to bring that 90,000, just like they did on the previous one, down to the beginning of the year balance. Multiply it times 40%, and we get 36,000. Okay. So my accumulated depreciation is 196. That book value is dropping fast. Okay. So here's where you kind of have to keep an eye on things. If we took that 54,000, multiplied it times 40% for the next year, that would drop us down too low. Okay. Because 40% of 54,000 is way more than the 14,000 we have left to depreciate it. Okay. So here we're going to actually, on this one, we're just going to take and subtract out the 40,000 to get us the 14,000 in depreciation expense. We're done. Okay. Year 5 gets 0 depreciation. Okay. This could roll over into a 6th year. Okay. It really depends a lot on how large the salvage value is. The salvage value was pretty large here, so we ended up depreciating it only 4 years, even though it had a 5-year life. We had a rather large salvage value here. If we had a salvage value of, say, let's just say 4,000. We very well could have taken the 54,000, multiplied it times the 40%, and gotten another year of depreciation. So here's where you just have to kind of watch it just a little bit and see when will you actually decrease below the book value. Okay. So just keep that in mind. All right, so that is double declining balance. Moving on, we're getting close to the end of this video. There is the concept check if you want to work that. So now we are at sum of the year's digits. Okay, so we have sum of the year's digits. This is another accelerated method, and I have the formula that we need to do the sum of the year's digits somewhere here in my papers. All right. So, oh, there it is right down here. Okay. So we're basically taking, this is a 5-year life. So we take 5 plus 4 plus 3 plus 2 plus 1. If you add all that up, it equals 15. So that was pretty easy because it was only 5 years. What if it was 30? Okay. There's a little formula right down here that you can use. And so they put the 5, they've already got it there. So 5 parentheses 5 plus 1 divided by 2. Okay, so that will end up giving you the number you need for sum of the year's digits. Okay, so we have 15. That is going to be our denominator. In each one of these fractions, we're going to take that depreciable base and we're going to multiply it times the fraction. In year 1, we're going to multiply it times the fraction 5 divided by 15. Okay, not quite as much as double declining balance, but quite a big depreciation expense here. Okay, accumulated depreciation, remember that's our contra asset account, and then that leaves us a book value of 180. It's not double declining balance, so I don't need to bring that 180 down here. I just need to still use my 210, multiply that in year 2 by 4 divided by 15. Okay, and you can kind of see the pattern: 5, 4, 3, 2, 1 for years 1, 2, 3, 4, 5. Okay, and so that will end up giving us that book value at the end of its life of 40,000. Okay, so now we have the activity-based method. Okay, and so here they tell us the how many units were produced. Okay, so the first thing we have to do, I didn't write my blurb of information over here. We have our cost, 250K, residual value of 40,000. Sorry, I don't know why my computer does that every now and then. 40K, and we have 5. We don't need to use the 5 years. We're going to use 100. Sorry. 140K units. Okay. So we're going to find a per unit depreciation. Okay. Per unit. So we're still going to take that depreciable cost of 210,000. Go ahead and put all my zeros out, and we're going to divide that by 140. Yes, I know this says 150, but at the time of the estimate, we estimated 140. So to calculate our rate, we're going to use the 140. Okay, so we end up with $1.50 per unit. Okay, So it's pretty easy. Year one, 20,000 units. We're going to multiply that times 1.5 to give us 30,000 in depreciation. Okay. Units of production really is a depreciation method that follows the actual usage of the asset. Okay. Year two, we have 32,000, multiply it times the same per unit rate. And then we're going to keep on coming down here. Notice that in year five, we used it said 26,000 units, but we only estimated to 140, so we can't take 26. We can only do 24,000. Okay, basically, this should be 16,000 units multiplied times 150. Okay. Again, depreciation expense total or accumulated depreciation is 210. It does not matter which method you use, that number will always be the same. Okay. How much you depreciated, the total of all of those is 210. The accumulated depreciation will be the exact same amount. The book value at the end does not matter which depreciation method you use, will always be the salvage value. Okay. So here is a nice little comparison of all the different methods that we just did. And what did I just tell you? Every single one of these has a total of 210,000. So if you do straight line, double declining balance, or units of production, and you can't remember how to do some of the year's digits, you can fill that number in because you know it's going to be the same as the other ones. Try to get every single blank that you possibly can correct. All right. That's all for the first video, and I'll see you in the next one.